So here's the first question in the examiner's report from September-December 22. And it was a step acquisition question where what happened was you'd first of all had an associate because you owned 40% of it. And then the second step, you bought a further 35. So you now own 75%, you had voting rights, and so you'd acquired a subsidiary because you now had control. Okay, and the question was all about then, how do you deal with these things? Well, obviously an associate is equity accounting. And it says, well, how do you deal with that in the profit or loss account? So really simple, should know this then. An associate in the profit and loss account, simply take your percentage of their profit after tax. Now, they're only an associate for 8 months, do it for 8 months, okay? If you'd got the timing wrong, the examiner said, look, we'll mark you down once, but that's it. The rest of it, we'll pretend you got it all right. So that's good news. So we've got that bit. Now we acquired another 35%. So now it's become a subsidiary. And so what you have to do immediately is remeasure the original 40%. Okay, so you remeasure it to its fair value now, and any gain or loss would go to the P&L. So now you've got a subsidiary at 75%. How do we deal with a subsidiary in a profit or loss account? We acquisition account for them, which means add everything across in the P&L, more or less, for 4 months, because it was an associate for 8 months. So just 4 months, 100% added across. And because you've added across 100%, but you only own 75%, you've got 25% NCI as well for 4 months. And that was it. So it's generally basic knowledge. That is the knowledge you need for a step acquisition, and that will get you the full marks in the exam. Okay, so continuing with that question, it talked about how the goodwill will be calculated. And so goodwill, we know, is fair value of consideration plus the fair value of NCI less the fair value of net assets acquired at the date that we took control, okay, at the date it became a subsidiary. So you might have needed some fair value adjustments at the control date. I don't think there were any, though, in this question. And then what you do is when you work out the fair value of consideration, because you bought it in 2 parts, you take the bit you've just paid, the 35%, and the remeasured one. Remember, we remeasured the original one. Those two added together, they're your new fair value of consideration. Okay, and then the question went on to a different company where we got a question asking for, right, tell me about the individual and the consolidated financial statements. So you have to obviously do both. Now, this 30% investment was a contract where we had joint control over it with somebody else. So as soon as you see that, you think, right, this is a joint arrangement as opposed to an associate. You look at it and you saw that we'd given guarantees over their liabilities. So this was actually a joint venture. Okay, straightforward, nothing difficult. In the individual accounts, like in any individual accounts and any investment that we have, you could just keep it at cost or you could keep it at fair value. And because it's a 30%, you could also equity account for it in your individual company as well. In the group accounts, though, because it's a joint venture, you equity account for it. As simple as that. The next part of the question asks for a discontinued operation. So your knowledge of discontinued operation. This was a group. So it's a disposal group. Because we're going to dispose of it, we were going to sell it. So it needed to be a held for sale, this bit. So what you first of all need to do in a held for sale is remeasure all the assets and liabilities according to their particular standards. So you remeasure them all and then you classify it as held for sale. Now, when we bring it into held for sale, you're going to bring it in at the lower of carrying amount and fair value less cost to sell. Okay, so we remeasured it and then we value it as we should at the lower carrying amount and fair value less cost to sell. And therefore, there's probably going to be a little impairment, and that impairment will reduce goodwill first unless told otherwise.